Great. Don Luskin, let me just get a quick take from you because I think you've been following this story. Number one, they're getting creamed on these credit default swaps. They're going to have to put up a ton of new collateral. At the same time, they're going to raise money, Don, but they also raise their dividend. I don't really think any of that makes sense or hangs together. I agree with Vince. It could be the gang that couldn't shoot straight. That's my phrase, not his.
It just goes to show that their CEO is definitely not a finance guy. This is a great mystery. Why you would go to capital markets to raise billions of dollars in order to turn around and increase your dividend to people who already have given you their capital. Why don't you just cut the dividend to zero and treat that as a kind of implicit capital raise without any transaction costs?
Because they want to give the government more taxes.
But whoever designed this model of corporate finance was the same guy who designed the government stimulus package, where you steal from Joe and give the money to Jim and call it stimulus. Well, we're going to raise the money from Joe and we're going to pay the dividend to Jim and we're going to call it progress. That's ridiculous.
I just want to put the comment here that the reason they pay dividends and then raise capital is because they really think they want to solve the federal budget deficit problem. They want to make sure that this company pays the most taxes it possibly can.
Well, wait a second. Can I just hang on to that?
So Arthur,
I want you to
Obama would call a patriot corporation.
A patriot corporation, you got it, exactly.
Don Luskin, I thought you were going to say the reason they're raising dividends is because the dividend tax rate is low at 15%.
No.
And who knows, Don Luskin, it may only be a few months more that it's this low. Could that be a factor?
No, it can't make sense.
I'll tell you, I'm hoping for months. Right now, it feels like minutes, Larry.
All right, minutes. Yeah, we're going to get to the Obama effect in just a moment. Sorry,
I'm not sure any of us on this brilliant all-star panel, as you phrase it, could do any better.
Don Luskin can do better. I want to see Luskin run that whole operation. But can see this. First is gold and oil. We're measuring this from early February. Let's get that up here. Now, I have indexed this chart from early February. Oil is up 43%. Gold is actually down. It's actually flat and down slightly. Oil is up 43%. That's just in a couple of months. It's incredible. Now, let's go to the next chart. There is a relationship between gold and oil. That is to say, historically, an ounce of gold generally purchases a fixed amount of oil because gold is a standard of value. What we find, though, is in the last 20 years, that is not the case. From 1988 to 1999, we'll just call that 10 years, an ounce of gold bought 20 barrels of oil. However, between 1999 and today, an ounce of gold has only bought 10 barrels of oil, roughly half. And the last reading is, by the way, at $126, and gold is at $380 and change. An ounce of gold is only buying 7 barrels of oil. Now, Don Luskin, when I look at the last 8 or 10 years, and I see the average relationship of this gold-oil ratio is 10 barrels, and we're not so far from that. It's a little lower, 7 barrels. If the relationship held, we'd be closer to about $85 or $90. But what does this tell you? Why has this relationship shifted? What does it suggest about the power of oil that maybe we should be thinking about?
You know, I have to tell you, Larry, I'm not a big believer in the oil-gold ratio. It's one of these ratios that, over time, travels great distances above and below its mean. And yeah, if you look at the chart over long sweeps of history, it looks mean reverting in that it constantly crosses the mean back and forth, but it doesn't spend really very much time at the mean. So I actually don't think it has that much value.
Here, here.
Especially when you're living in day-to-day speculative, politicized markets. Oil right now is just a runaway train. It's just got its own crazy logic. It could be up 20 points tomorrow or down 20 points tomorrow.
Let me put this thing back up here, the gold.
And that means no recovery in the second half. That means the third phase of this recession. First one was housing, second was Wall Street, third is the consumer, and the fourth is as it rolls out to the rest of the world.
Take me out with a one-sentence rebuttal.
We're not even in a recession, and he's already looking for the third phase of it. I love it. I love it. I want his job.
All right, hang on. You all are coming back. Don Luskin, are you worried about the Fed easing this winter as oil went up 43%? Isn't that usually, traditionally, historically, earthly, a great cause of inflation?
It's a terrible problem. The Fed should not have been easing anywhere near as much as they have starting last September. They should have started from the very beginning of this credit crisis creating direct, sterilized liquidity injections through devices that they came up with way too late, like the primary dealer credit facility and the term securities lending facility. They need to get rates back up and put the inflation genie back in the bottle, oil or no oil.
Luskin, the gold signal has proven to be more prescient, at least in the last half year, about inflation than any other signal. Money or the bond spreads, it really has. Now, fiddling around with a simple model of gold and inflation with a 2-year lag, I have a picture here of future inflation that is not pretty. And it actually shows in the last 4 or 5 years, it's only missed by about 0.3%. You know what it's forecasting? 5% inflation this year, and in round numbers, 6.5% inflation next year, 7% inflation after that, and then maybe it'll come down around 2010, Don. Now, this is simplistic stuff, all right? But it just shows you the gold signal. Now, gold is flattened out. That's great. But I don't know. I think inflation's in the air. Art doesn't. I do, Don. Where are you going to come out? And then we're going to get to our deflationists.
It's funny. I kind of see it both ways. I think inflation is definitely in the air, and I don't disagree with the calendar you laid out or the general order of magnitude of what we're going to see in reported inflation numbers over the last couple of years, because that's going to be the lagged pipeline effects of what gold was signaling when it was trading at 130, or rather 1,030, on March 16th, the Sunday night before the Bear Stearns rescue. Now, gold is off about 15% from that high, which tells me that the worst of the crisis is over. And as gold stays down in the 800s, and I think it'll get down into the 700s, that's going to start perturbing the forecasts in that model. And it's going to start bringing down your peak inflation. It's going to start compressing the end point at which the worst-case inflation statistics are realized. So I think we've avoided the terrible worst case. But, yeah, I don't have any problem believing we're going to see headline inflation in the 5s and the 6s over the next couple of years.
It's interesting, Vince Farrell, on this.
I think you're going to see all the commodities, including oil and rice and wheat and copper, fall as well.
Don Luskin, that's the outcome and scenario we want. The question, Don Luskin, is what's going to make it happen?
It's as simple as 3 little letters, Larry. F-E-D. That spells Fed.
And?
We simply need the Fed to signal the market that it is done, that it is going to start raising the funds rate and relying on its new targeted liquidity mechanisms to deal with whatever's left over the credit crisis. And when that'll happen, the bottom that's already in the dollar, the top that's already in gold, the bottom that's already in stocks will just continue to play out. We'll just keep on going the way we've been going for the last 2 months.
Don Luskin, does the stock market want the Barney Frank plan?
I do. I think the stock market does.
You do? I know. I've heard this. Listen, Dougie Cass has been hammering me. He's emailing me. So, Don, you think it's a good thing because what? It'll clear out some of the inventories.
Well, it's not perfect, but and I wish government didn't have a role in a lot of things, but it does. It's, we live in the moral hazard state. The one thing the government can do is underwrite risk. It's the great risk pool. So, I think they're getting it approximately right because it is a voluntary program.
And Steve, let me just come back to your point. Don Luskin, you're a brave chap. Now, hang on a second. I want to get away from the social politics. Don, if there's an FHA, why not use it? That's what you're saying. It might help the stock market, Don. That's the thing. It might help the stock market. I'm going to give you the last word.
I think it'll help the market clear. It'll help people refinance. It'll help everybody write off their losses and move forward.
It will accelerate the correction. I think it will accelerate the correction.